In this podcast episode, host Stephen Bartlett interviews Ben Felix, a seasoned investment expert known for his evidence-based approach to personal finance. They explore a wide array of financial topics, from the true costs of homeownership and the psychology behind investing, to common money mistakes, tax planning, and the impact of technology like AI on the economy. Throughout, Ben draws heavily on academic research, sharing practical insights relevant to people at different stages of their financial journey. Ben begins by addressing one of the most significant financial decisions many face, whether to rent or own a home. He emphasizes that owning a home comes with numerous unrecoverable costs that people often underestimate, especially maintenance and emergency repair expenses. Property taxes, mortgage interest, and the opportunity cost of home equity, i.e., the returns foregone by tying money into real estate instead of investing it elsewhere, form significant invisible costs. Maintenance, often pegged by studies at about 1 to 2% of property value annually, can in reality be much higher and also sucks up valuable time. Ben introduces a 5% rule as a simple heuristic to compare the cost of owning versus renting. When property taxes, maintenance, and opportunity cost are added, they approximately total 5% of the home's value annually. By dividing the home price by 5%, then by 12, you find the equivalent monthly rent that makes renting financially on par with owning. For example, a $300,000 home translates to an equivalent rent of around $1,250. If rent is higher than that, renting financially beats owning. He also discusses the impact of mobility and market timing on this decision. For young people especially, locking into homeownership can limit career mobility and lead to opportunity costs that are rarely quantified but are very real. Ben's personal experience of moving multiple times before settling into a larger family home illustrates the flexibility renting affords. Moreover, he challenges the popular anecdote that because a family member bought a house decades ago and it appreciated dramatically, buying is always a wise investment. Market conditions change, and recent Canadian real estate trends have shown significant price corrections, underscoring the risk and cyclical nature of the property market. Beyond finances, Ben acknowledges the psychological value of homeownership for some, offering stability and a sense of control over one's environment. However, statistically, once you control for factors like neighborhood quality and property type, homeowners are not necessarily happier than renters. Ben highlights that while the mechanics of investing, especially using low-cost index funds, are well understood and relatively straightforward, the bigger hurdle is human psychology. Our brains are wired for short-term survival, not for the abstract, long-term thinking needed to invest consistently through market volatility. He cites research showing that investors who frequently check their portfolios tend to take less risk and achieve lower returns, as the daily market fluctuations cause stress and lead to suboptimal decisions like premature selling. Thus, a key to successful investing is often not looking at investments too often and having the conviction to maintain a long-term plan. The conversation introduces the PERMA model from positive psychology, positive emotion, engagement, relationships, meaning, and accomplishment, as a framework for setting financial goals aligned with one's definition of a good life. Ben stresses that clarifying these goals can help people direct their financial resources and avoid spending on things that don't truly enrich their lives. Ben presents 10 common financial errors, starting with the underestimated mistake of not earning enough money. He underscores the importance of investing in one's human capital through education and skill development to increase income potential, referencing the data-driven relationship between education and lifetime earnings. He acknowledges the challenge of predicting which skills will be valuable in the future, but encourages building a rare and complementary skill stack that aligns with market needs. Another pervasive mistake is saving too little, especially if individuals delay saving until late in life. Due to compound interest, the earlier one saves, the easier it is to accumulate wealth, making late starts difficult to overcome. Overspending on things that don't contribute to one's true goals is also highlighted, with examples like daily expensive coffees that add up to significant long-term opportunity costs. Ben quantifies this by showing how even small regular expenses, compounded at a stock market return rate, translate to large foregone wealth decades later. Failing to take appropriate investment risks is another common error. Ben explains the opportunity cost of avoiding stocks, which historically have returned about 7% annually, well above alternatives like cash. He advocates for a sufficient equity allocation to capture these returns, warning against overly conservative portfolios that sacrifice growth. However, he cautions against taking the wrong risks, such as heavily trading individual stocks, chasing speculative assets, or engaging in frequent trading, which typically erode returns due to costs and biases. He shares a nuanced perspective on homeownership, emphasizing that it's not purely an investment, but also consumption and reflects lifestyle choices. For people who are very risk-averse or want to remain in one place long-term, owning may make sense, especially when factoring in tax advantages on primary residences. But for many, investing in the stock market offers better financial growth and liquidity. Missing tax planning opportunities is another mistake Ben highlights. He recommends maximizing the use of tax-advantaged accounts like RRSPs and TFSAs in Canada or IRAs and 401ks in the U.S. While higher-income individuals may have more complex strategies, most can benefit substantially from simple optimizations. Ben notes that many people underinsure against catastrophic risks, failing to secure adequate life or disability insurance, which could financially devastate households dependent on their income. Additionally, the interplay between personal relationships and finance comes up. Ben discusses how money personality types, classified as tightwads or spendthrifts, affect marital harmony and financial success. Research indicates opposites attract but frequently lead to conflict, signaling the importance of open communication and alignment on financial values. The sensitive topic of prenups is introduced as a pragmatic tool to manage potential future conflicts without necessarily being unromantic. Ben advocates a straightforward investing approach. Buy and hold low-cost, globally diversified index funds with an appropriate domestic bias, roughly 1/3 domestic stocks and 2/3 international stocks, as supported by large data-driven studies. This strategy is shown to outperform complex, time-varying allocations that shift toward bonds with age, which were once conventional wisdom but have been challenged by recent research. He warns against thematic ETFs that chase hot trends like AI, cannabis, or space exploration. These funds often launch when valuations are high, and subsequent returns tend to disappoint investors who buy at the peak of hype. Ben critiques products such as covered call ETFs, which promise income by limiting upside potential through selling call options on owned stocks. While appealing due to perceived income, they often erode growth and don't properly account for opportunity costs. He also touches on the insidious drag of fees. Even seemingly small management fees compound negatively over time, significantly reducing investment outcomes. He stresses the importance of keeping fees low as part of an effective investing strategy. Holding cash, especially outside of inflation-protected accounts, is a costly mistake in the long run. Ben points out that inflation steadily erodes purchasing power, demonstrated by an example where $10,000 held as cash at 3% inflation loses almost half its real value over 20 years. The solution is to leverage stock market investments, which historically outpace inflation. While short-term government bonds may offer some inflation protection, their value can still be compromised in periods of high inflation. Ben discusses the increasing personal responsibility around retirement savings as defined benefit pensions decline. Though tools are better now than decades ago, such as widely available low-cost index funds, individuals must plan carefully to maintain their lifestyle in retirement. He indicates that retirement planning should integrate with a person's overall life goals and the PERMA model to ensure one is saving for a meaningful and satisfying future rather than simply accumulating wealth blindly. The discussion turns to the rise of AI and its implications for jobs and investing. Ben provides historical context, explaining that technological revolutions have continuously disrupted labor markets, but generally created new opportunities as old jobs were redefined or replaced. Examples like the advent of ATMs didn't cause long-term job loss for bank tellers, but changed banking in unexpected ways that increased overall employment. He admits that the rapid pace of AI adoption poses unique challenges, with some labor sectors at risk of disruption, but cautions against panic by highlighting the adaptive nature of economies over centuries. For individuals, acquiring complementary rare skills remains a critical defense. For investors, the current fervor around AI startups and related speculative investments is reminiscent of past technology bubbles. Ben references academic work suggesting that these cycles of hype and correction are typical and implies that while corrections occur, diversified portfolios tend to weather them better than concentrated bets. Ben stresses the concept of market efficiency. Prices already incorporate all known information, making it extremely difficult to beat the market consistently, even for professionals. This underpins his advice to rely on broad market index funds rather than costly active management or speculative investment. Ben briefly addresses cryptocurrency, acknowledging the innovative breakthrough of decentralized digital cash, but dismisses it as a sound investment. He categorizes Bitcoin and Ethereum more as ideological or speculative assets rather than suitable components of a diversified portfolio. His firm does not invest clients' money in cryptos, and he personally holds only a very small amount for educational purposes. Ben discusses the challenges inherent to the financial advice industry, noting that many advisors operate under sales incentives that may not align with clients' best interests. He suggests that while many people could benefit from quality financial advice, finding trustworthy and competent advisors can be difficult. He encourages referrals and diligence in selection, but notes that simple, research-backed strategies often don't require a financial professional. The episode reviews data showing that women generally outperform men in investing, attributable in part to less overconfidence and a lower tendency to trade excessively. This leads women to achieve better returns during comparable periods, highlighting behavioral factors as key to investment success. Finally, reflecting on the cyclical nature of economic and geopolitical turmoil, Ben advocates for maintaining a long-term perspective. Historical data shows markets overall trend upward despite wars, crises, and disruptions. He counsels that volatility is inevitable, but well-diversified investments and solid financial plans should not be abandoned in response to short-term fears. Ben directs listeners to his YouTube channel and the Rational Reminder podcast for continued education. His firm, PWL Capital, offers online tools such as rent versus buy calculators and goal-setting applications designed to help individuals make informed financial decisions grounded in research.